Moving on to the retail snapshot, we'll look at the leasing trends, then we'll have an overview of all the different sectors, and then we'll, of course, get the tenant perspective. So moving on to the leasing trends, the Australian retail market continues to show mixed performance across the different sectors. In large format retail sector, vacancy has decreased due to limited new stock entering the market, and this supply constraint has contributed to sustained demand for available space. In contrast, vacancy rates in other retail sectors remain relatively static, though notable disparities exist within the different sub-markets. So strip retail, for instance, is experiencing higher vacancy rates in some locations, while shopping centres continue to maintain tight occupancy levels. These variations highlight the evolving nature of consumer behaviour and the shifting dynamics within the broader retail landscape. Despite softening retail spending with households adjusting to cost of living pressures, we continue to observe upward pressure on effective rents. Across most retail markets, rents have increased while incentives have declined, reflecting continued demand for well-located retail spaces. One point of relief for retailers is the easing of the CPI-linked rent increases. After reaching a peak of 7 to 8% in 2023, CPI has now reduced to around 2 to 3% in most markets, providing some stability for tenants facing cost pressures. I'll now hand over to Adrian.
Thanks, Ed. So as Graham highlighted the barometers within the office market, the lease norms for retail remain unfriendly due to the supply side power and market coverage that landlords hold as a collective over retail tenants, as well as restrictions within retail leasing acts. With the market conditions, they are quite varied, as Ed said, over the different types of retail. In theory, they should favour the tenant. However, landlords are not taking into consideration the needs of tenants in light of the current economic conditions. The retail market experiencing difficulty due to inflation and interest rates, landlords should look at ways they can assist their tenants and create long-term relationships, not hinder the tenant. In a recent example, a shopping centre landlord was seeking an inflated rent that they weren't prepared to negotiate on. When the landlord found out that we had found an alternative location outside the centre for 75% less rent, only then were they prepared to drastically reduce the rent, which was too late. A win for the tenant and a rare example of a retail tenant creating leverage within a shopping centre, but it just shows how difficult negotiating with shopping centre landlords can be and how much power and information they hold. Go to the next slide. So the LFR sector received a boost in December on the back of the longer Black Friday and Cyber Monday periods, with household goods retailing increasing by 1.6% from November. The lack of new property space in large format is still continuing to force rents to increase, with limited opportunities for new and relocation sites and a lot of deals being negotiated off market. Just recently, we received information on a new LFR development in suburban Brisbane, with rents pushing $450 a square metre. However, for some tenants, the rent increases along with the economy and the hike in construction costs is making new sites difficult to justify. And we're seeing some opportunities present themselves whereby existing tenants cannot keep their doors open. A good example of this recently is the Mosaic brand collapse and Rivers, with sites now presenting opportunities for LFR retailers who can move quickly and have a mandate to open more stores. Most landlords are accepting of incentives on new sites. However, incentives on renewals are almost non-existent given the increased cost of borrowing money. Time and skill is required to achieve results in this area. Currently, many large format clients are investing in data, market research and benchmarking, as well as network plans to help inform them from a portfolio perspective on where to select the best locations, especially given fit out costs, the reduced amounts of CapEx available, and the need to maximise store sales productivity given the lack of floor space available. Again, whilst the Black Friday and Cyber Monday promotions in November saw sales up year on year, sales did slow down in the pre-Christmas and Boxing Day periods. Retail spending rose by 1% in the December quarter. However, the month of December itself fell by just 0.1%. Clothing, footwear and personal accessory retailing fared the worst, with a 1.8% drop in December, along with cafes, restaurants and takeaway food services with a 0.5% drop. As we move into Q1, shopfront conversion becomes more important than ever, as until we see interest rate cuts, Q1 will be challenging for retailers while shoppers and their credit cards recover from the November and December sales periods. Shopping centre landlords are still seeking rent increases on renewal by 5 to 20%, along with longer lease terms and fit-out upgrades. Many tenants in larger shopping centres continue to be affected by relocations on renewal, as the landlords revisit tenancy mixes and seek international tenants and new brands to maximise turnover and retail growth. As with large format retailers, the shopping centre sector is also feeling the effect of the Mosaic brand collapse, with the likes of Nonny B, Miller's, Rockman's and Autograph closing. However, this is creating opportunities for retailers. One client that we are currently working with is moving from online retail to bricks and mortar by committing to 10 sites around the country on short-term reduced rent leases and taking advantage of reusing existing fit-outs. As we discussed with large format retail, landlords are only providing incentives on new sites, and even then the amounts are reduced or reflected within a higher face rental. With the CBD, retail rents have remained stable over the past quarter due to the effect of interest rates and reduced discretionary spending. However, the CBD will more than likely never return to pre-COVID levels due to the change in office working habits, especially Melbourne, where food and beverage retailers dependent on office workers are continuing to struggle. If a landlord wants to seek a new cafe tenant in an office building, they are more than likely having to subsidise a large percentage of the normal asking rent. In the suburban market, it is two-paced. In the busy prime suburban strips like Chapel Street, South Yarra, James Street, Fortitude Valley, plus tourist areas such as Noosa and Burleigh Heads, vacancies are rare, rents are increasing, and the new opportunities are mainly sourced off-market. However, in the secondary locations, there are many options. However, landlords are hesitant to provide generous incentives given most are smaller investors. Tenants are also much more considered in their decision-making with new sites. Given the investment required for a fit-out and the challenging economic conditions, tenants are only considering sites that tick all their boxes from a location, signage and parking perspective. No longer will they consider a secondary location that they may have accepted pre-COVID, as they want to ensure that their business has the best opportunity to be successful. Landlords need to continue to be reasonable, implement rents reflective of market, and recognise the current pressure on retailers. There are a number of strategies that a tenant can enact to receive favourable outcomes within the retail sector. I've highlighted two strategies in orange that have relevance to the slides that we've just previously gone through. First is premises due diligence and negotiation. Use data, consider customer demographics, research rents, and benchmark against competitors to ensure that the entire portfolio performs and the sites are in the right locations. And then go big for substantial change and risk transfer. Look at situations like the Mosaic collapse and like the client we are working with to use it as an opportunity to maybe take some risks of opening more stores, which will develop into potential of substantial increases in revenue. Thank you.
Thanks, Adrian.